What if I told you that by 2030, 3 simple investments could send you a paycheck every single month without you ever having to work again? While most people are stuck in the endless cycle of trading time for money, showing up to jobs they hate just to pay bills, smart investors are quietly building passive income machines that work 24/7. Today, I'm revealing the exact 3 monthly dividend ETFs that could completely replace your salary. And these aren't some risky penny stocks or get-rich-quick schemes. We're talking about investments backed by over $45 billion in real money and verified data from official SEC filings. These aren't my random picks either. They represent the market consensus from top financial platforms. So if you've ever dreamed of financial freedom, stick around because what I'm about to share could change your life forever. Imagine waking up every month and seeing money deposited into your account like clockwork, but instead of a boss signing your paycheck, it's coming from some of the world's largest and most profitable companies. We're talking about ETFs that manage more money than the entire GDP of over 100 countries combined. This isn't fantasy. It's happening right now for thousands of investors who understood one simple truth. The wealthy don't work for money. They make money work for them. By the end of this video, you'll have the exact blueprint that could turn a modest investment today into salary-replacing income by 2030. You'll know exactly which 3 ETFs to buy, how much to allocate to each one, and why timing is absolutely critical right now. But first, let me show you why 2025 represents a once-in-a-decade opportunity that you simply cannot afford to miss. Something incredible is happening in the markets right now that most investors are completely missing. Dividend yields are hitting levels we haven't seen in years, and it's creating a perfect storm for income investors. Take JEPI, for example. Right now, it's paying an incredible 8.40% annually, which is significantly above its 3-year average of 6.89%. But here's the secret: market volatility is actually boosting these dividend payments through something called options premiums. When markets get choppy, these ETFs can charge higher prices for the options they sell, and that extra income gets passed directly to you as higher dividends. It's like getting paid extra money specifically because the market is uncertain. But here's the thing: this window of opportunity won't stay open forever. As markets stabilize, these elevated yields will come back down to normal levels. That's why 2025 is the perfect time to lock in these higher income streams before they disappear. ETF number 1, JEPI. Let me introduce you to the first champion in our salary replacement strategy, JEPI, the JP Morgan Equity Premium Income ETF. This is the heavyweight champion of the dividend world, and the numbers will blow your mind. GP manages an absolutely staggering $41.27 billion in assets, making it the largest actively managed ETF on the entire planet. Think about that for a second. $41 billion. That's more money than most countries have in their entire treasury. Right now, JEPI is paying an incredible 8.40% annual yield, which means for every share you own, you're getting $4.78 in dividends every single year. But here's what makes it even more exciting. Those payments come every month like clockwork. Last month, September 2025, JEPI paid $0.368 per share. The month before that, August, it was $0.358. July was $0.400, and June was an incredible $0.540 every single month. Money hits your account whether you're sleeping, on vacation, or just living your life. But how does this magic actually work? JEPI uses what's called a covered call strategy, and it's absolutely brilliant. JP Morgan's team of professional money managers owns a carefully selected portfolio of about 115 large-cap U.S. stocks, companies like Microsoft, Meta, Nvidia, Oracle, MasterCard, and Amazon. These are some of the most valuable companies on Earth. Then, they sell call options against these stocks, collecting premium income that gets distributed to shareholders like you and me. It's like owning a rental property, but instead of collecting rent from tenants, you're collecting options premiums from other investors. The track record speaks for itself. Over the past 5 years, JEPI has delivered 11.6% annualized returns while paying you monthly dividends the entire time. That's the definition of having your cake and eating it too. You're getting consistent income plus long-term growth from owning pieces of the world's most successful companies. ETF number 2, SPHD. Now let me introduce you to the second piece of our salary replacement puzzle. SPHD, the Invesco S&P 500 High Dividend Low Volatility ETF. While other investors are chasing risky, unsustainable yields that could disappear overnight, SPHD does something much smarter. It screens the entire S&P 500, all 500 companies, looking for the perfect combination of high dividends and low volatility. Think of it as the defensive player on your income team. Right now, SPHD is yielding 3.46%, and while that might seem lower than JEPI, there's a really important reason why this ETF deserves a place in your portfolio. This fund owns companies that have proven they can pay dividends through good times and bad times. We're talking about businesses like Altria Group, Alexandria Real Estate, Conagra Brands, Pfizer, Verizon Communications, and Realty Income. These are companies that have been paying dividends for decades, through recessions, market crashes, and every economic crisis you can imagine. What makes SPHD truly special is its automatic rebalancing system. Every January and July, like clockwork, the fund kicks out companies that are no longer meeting its strict criteria and adds new companies that are performing better. It's like having a professional money manager constantly optimizing your portfolio for you. The sector allocation tells the real story of why this ETF is so reliable. Nearly 24% is invested in real estate, 17.5% in consumer staples, 13.4% in utilities, and 11.7% in financials. These are the sectors that keep generating income no matter what's happening in the economy. People always need food, electricity, housing, and banking services. The long-term track record is absolutely impressive. Over the past 5 years, SPHD has delivered 12.08% annualized returns, and over 10 years, it's averaged 8.93% annually. This is what consistent, reliable performance looks like in the real world. ETF number 3, SDIV. Now let me blow your mind with the third and most aggressive piece of our income strategy. SDIV, the Global X Super Dividend ETF. If you thought the other yields were impressive, wait until you hear this. SDIV is currently paying a mind-blowing 9.64% annual yield. That's nearly 10% of your entire investment coming back to you every single year in dividend payments. But here's what makes SDIV truly unique and powerful. While American investors are fighting over scraps in the U.S. market, SDIV owns high-dividend companies across the entire globe, with over 70% of its holdings in international markets. This is the kind of diversification that most investors never even consider, and it's opening up income opportunities that simply don't exist in the U.S. market. The track record for consistency is absolutely incredible. SDIV has been paying monthly dividends for 14 straight years, since June 2011. Think about that. Through the 2008 financial crisis aftermath, the European debt crisis, COVID-19, inflation, recession fears, market crashes, everything you can imagine, and SDIV has never missed a single monthly payment. That's the kind of reliability you want in an income investment. And 2025 has been an absolutely incredible year for this fund. It's up 22.7% year to date while still maintaining that massive 9.64% dividend yield. That combination of income and growth is extremely rare in today's market. Let me give you a peek into what you actually own when you buy SDIV. You're getting exposure to companies like Marfrig Global Foods from Brazil, D'Amico International Shipping from Europe, SESSA from Luxembourg, JBS from Brazil, and Aker BP from Norway. These are profitable, dividend-paying companies that most American investors have never even heard of, but they're generating serious cash flow in markets around the world. The geographic diversification is incredible. Significant exposure to Brazil, Norway, Luxembourg, Canada, and the United Kingdom. The monthly payments have been rock solid throughout 2025. September was 0.19 per share, August was 0.19, July was 0.19. Every month, like clockwork, that money hits your account. Over the trailing 12 months, SDIV has paid out $2.32 per share in total dividends. Now, I need to be completely honest with you about the risks. SDIV does have a higher expense ratio at 0.58%, and because it invests internationally, you're exposed to currency fluctuations and foreign market risks. The long-term total returns haven't been as strong as the other two funds, with 5-year annualized returns of 2.78%. But here's the thing. If you're focused on current income and maximum yield, and you understand the risks involved, SDIV can be an incredibly powerful component of your income strategy. Now let me give you the exact step-by-step blueprint for using these 3 ETFs to potentially replace your salary by 2030. This isn't theory, this is a practical, actionable strategy that you can implement starting today. First, think of JEPI as your foundation. This should be 50 to 60% of your dividend portfolio. With its 8.40% yield, institutional-grade management, and $41 billion in assets, JEPI gives you the perfect balance of high current income and long-term growth potential. It's your reliable workhorse that will generate the bulk of your monthly income. Next, allocate 25 to 30% to SPHD as your defensive layer. Think of this as your safety net. With its focus on high-quality S&P 500 companies and lower volatility, SPHD provides stability and consistency to your income stream. When markets get rough, this is the fund that will likely hold up the best and continue paying those monthly dividends. Finally, put 15 to 20% into SDIV as your income accelerator. This is your high-octane boost that pushes your overall portfolio yield higher through that incredible 9.64% dividend. Yes, it's higher risk, but the reward potential is significant, and that global diversification provides exposure to income opportunities you can't get anywhere else. Here's where the magic of compound interest comes into play. Instead of spending those monthly dividend payments, reinvest them back into buying more shares. This creates a snowball effect where your dividends buy more shares, which generate more dividends, which buy even more shares. Start with $50,000 today. Add $500 every month, reinvest all those dividends, and by 2030, you could be looking at serious salary replacement income. Instead of waiting for a bi-weekly paycheck from a boss who could fire you tomorrow, you'll be getting paid every month by some of the world's most successful companies. And the best part? This income stream doesn't depend on you showing up to an office, dealing with office politics, or asking for permission to take a vacation. Before we wrap up, I want you to know that every single number I've shared with you today is completely verified and sourced from official fund websites and SEC filings. This isn't speculation or marketing hype. When I tell you JEPI manages $41.27 billion, that's straight from JP Morgan's official fact sheet. When I say SDIV has paid monthly dividends for 14 years, that's verified from Global X's official distribution history. When I quote yields and performance numbers, those come directly from the fund companies and multiple independent financial data providers. This also isn't just my opinion. These 3 ETFs represent proven, established funds with strong track records. All of this data is current as of September 2025, so you're getting real-time intelligence, not outdated information that might no longer be relevant. Here's what you need to understand. The window of opportunity we're seeing right now won't last forever. Remember, JEPI's incredible 8.40% yield is elevated specifically because of current market conditions and increased volatility. As markets stabilize, this yield will likely come back down to more normal levels. The same is true for the enhanced income opportunities we're seeing across the dividend space. This is your chance to lock in these higher income streams before they disappear. My recommendation is simple. Do your own research, consult with your financial advisor, and make sure this strategy fits your personal financial situation and risk tolerance. But don't let analysis paralysis cost you this opportunity. These aren't new, untested investments. SDIV has been paying monthly dividends consistently for 14 years. JEPI dominates the space with over $41 billion in assets under management. SPHD provides access to the highest quality dividend-paying companies in the S&P 500. Remember, past performance doesn't guarantee future results. And all investments carry risk, but 14 years of consistent monthly payments, billions of dollars in assets under management, and backing from major financial institutions like JP Morgan, Invesco, and Global X speak volumes about the stability and reliability of these income strategies. If this video opened your eyes to the incredible power of monthly dividend investing, make sure to subscribe to the channel because I'll be covering more advanced income strategies, portfolio allocation techniques, and market analysis that can help you on your journey to financial independence. And because while most people are planning to work until they're 65, you could be collecting monthly paychecks from the world's best companies starting today. The choice is yours. But remember, time is your most valuable asset when it comes to building wealth. And every month you wait is a month of potential income you're leaving on the table.